Every Forex trader hits the same wall early on. You are looking at a currency pair, and you have no idea whether to buy or sell. The answer usually comes down to two schools of thought: fundamental analysis and technical analysis. Understanding both is one of the most useful things you can do when you are building a trading approach. Fundamental analysis is about understanding what is driving demand for a currency. A country with a strong economy, rising interest rates, and political stability tends to attract foreign investment. That demand pushes the currency higher. The inputs fundamental traders watch include central bank interest rate decisions, inflation data, employment figures, GDP growth, and trade balances. When a central bank raises rates, for example, that country's currency often becomes more attractive to investors seeking better returns. Political events matter too. Elections, geopolitical tensions, and trade agreements can all move currencies sharply. Fundamental traders are trying to understand the broader economic story behind a pair, not just its price history. Technical analysis works from a completely different premise. The core belief is that everything already known about a currency, including its economic fundamentals, is already reflected in the current price. So instead of studying economic reports, technical traders study charts. They use tools like moving averages, support and resistance levels, trend lines, the relative strength index, and candlestick patterns. These tools help identify potential entry and exit points based on how price has behaved in the past and how it is behaving right now. Technical analysis can be applied across any time frame, which makes it popular with short-term and day traders who are not tracking macroeconomic developments closely. The clearest difference between the two comes down to focus. Fundamental analysis looks at why a currency is moving. Technical analysis looks at what the price is actually doing. A fundamental trader might buy a currency because interest rates are expected to rise. A technical trader might buy the same currency because it just bounced off a key support level. Same trade, completely different reasoning. Many experienced traders combine both, using fundamentals to determine the overall direction of a pair, then using technical analysis to time the entry. When both approaches point the same way, some traders consider that a stronger signal, but it still does not guarantee anything. Markets can and do move against even well-reasoned positions. Neither method is easier than the other. Both take time to learn properly, and no analysis system removes the risk that comes with trading. Most retail traders lose money, and leverage amplifies losses just as it amplifies gains. Only trade with capital you can genuinely afford to lose. If you want to test both approaches without financial pressure, a demo account at zenithfx.com lets you practice using real market data before you commit any real money.